Welcome to It's the Economy. The US Fed has triggered a rally that's showing no signs of abating. The US indexes have gained over 3% since the announcement of the policy by Jerome Powell, while India's Nifty is up nearly 300 points over the last 2 days. What should we expect from the US economy, the US yields and the dollar going forward? How much will yields fall further? And how much will the US economy slow and thus create a headwind for India's growth? For all these questions, I'm joined by Jahangir Aziz, the global head of EM economics at JPMorgan. Jahangir, good evening, and I can't tell you how grateful I am that you're staying up for me. Well, first, the market reaction. Market clearly believes the Fed is done with rate hikes. Is the market reading the Fed right?
So I wouldn't say that the Fed is done with rate hikes. Clearly, the Fed wasn't going to hike rates in the November meeting, given that you clearly have the uncertainty of a government shutdown in the U.S. looming. So December is still alive. But I think that what the Fed essentially said was that it was going to be very, very data dependent. And on Friday, we are going to have the non-farm payroll, and that will be a clear marker. And then we'll have the PCE numbers coming out. If the non-farm payroll numbers, which the consensus has about 190,000, but for the last 14, 15, 16 months, the actual non-farm payroll numbers have beaten consensus, including last month. So clearly there's an upside to that, just going by history. But if the number comes a tad lower, and if you do see some cooling off in wage growth, and you see the PC numbers holding where they are, then maybe you might see the Fed also on pause in December. But look, for all practical purposes, third quarter growth of 4.9%, that wasn't just resilience. That was sheer strength being shown by the U.S. economy. So I think it's a very tough call. But I think that the Fed made it clear that it's going to be very, very data dependent from now onwards.
So in your book, another hike is not ruled out.
So we do not have, that's not in our baseline. Our baseline has that the Fed has been done and that the Fed is now on a prolonged pause. That's clearly the baseline, and that's clearly consistent with the view that this time around the Fed can engineer a soft landing. We do have a soft landing in a baseline, but the risk is that this is going to be much more difficult to achieve, and the risk is that the macro data may not be in that direction, and that's the reason why we think that the Fed most likely is going to be data dependent, rather than saying that it is done and dusted. You never say done and dusted for the Fed.
Okay. Well, let me take up on your statement on the US GDP growth, 4.9. You said it's not resilience, it is strength. Now, the 4.9% in Q2 was, a huge growth. How will 2024 do? Is it therefore just a minor dip, or is it a deeper, longer recession?
So we are looking for a slowdown. We are looking for an appreciable slowdown in the fourth quarter itself. But again, so far the numbers from the surveys have shown that slowdown probably is on the cards. But if you recall, over the last 18 months, the survey numbers, whether you're looking at PMI or ISM numbers, the outcome has always been in a completely different direction. I mean, recall that, around this time around last year, we were all looking at these survey numbers and you're saying, okay, there's an imminent recession. And clearly, 3 quarters or 4 quarters down the road, we have US posting one of its highest growth rate in a quarter. So I think that, we should, have a slowdown in the baseline. There's no question about that. The excess savings is dwindling. You are seeing, earnings of at least of some companies slowing down. You're seeing guidance from various different companies that are talking about a slowdown in earnings taking place, and it's happening right now with the earnings seasons. But at the same time, we have underestimated the resilience of this economy for a very long time. And my sense is that that would be a bad thing to underestimate again.
Oh, yes, that fear is there. That's why I asked you that question. What about the global growth headwind for a country like India? Europe is already in recession. China's not really firing. US was the only growth engine. And if that sputters, will the Indian growth story face a major global headwind in 2024?
So in 2024, if you look forward to it, there's several things that is running against an emerging market country, particularly India. So regardless of what is, the quarterly path going to be, chances are that the U.S. economy for 2024 is going to be slower than in 2023. As you talked about, Europe is already in a very fragile state. In addition to that, you are probably going to see some stabilization taking place in China, but it's unlikely that in China in 2024 will deliver you a growth rate higher than in 2023. So we are 5.2% for 2023. We are 4.9% in 2024. If you look at global financial conditions, the US 10-year has moved about almost 100 basis points than what we had back in, let's say, 4 or 5 months back. The dollar remains strong because there is nothing that is showing that the dollar is going to weaken. And turning to the domestic side of the economy, almost all economies on a forward-looking basis, with inflation coming down, real rates are going to be higher. So there isn't really any place you can point to and say, okay, that is going to be growth supportive. But my point is that, look, we had this similar kind of, probably even worse, dynamics on the global front in 2023, and clearly in 2022 it was even worse. But despite all of that, if you look around the emerging market world, all the major emerging market countries are still standing. And yes, growth might be par or subpar, but I think the kind of things that get emerging markets into trouble, which is, runaway current account deficits or, capital outflows taking place, which leads to a sudden stop in capital, I really don't think those are the kind of things that is going to happen. So, we are probably going to slow down, but it's a slowdown where, if you deliver a slowdown and you avoid a financial crisis or large capital outflows, when the 10-year is at 5% and dollar is at this high, I think it will be actually a very good outcome.
Okay, that's not good enough for us. We want to know, how much do you think India can slow? The RBI governor just said that India will do better than the 6.5% forecast for Q2, the quarter gone by. The Q2 numbers come out, of course, later this month, but how much do you think India can slow next year?
So what we are looking for the fiscal year ending in March of 24, so no, remaining 2 quarters included, we are looking at something somewhere between 5.5 and 6. And the reason why we are looking at that is because we do think that the global slowdown, the global headwinds that we just discussed, those are going to start biting from the fourth quarter, go into the first quarter of 2024, and that will have a material impact on India's growth because if you recall, it's literally 2 engines of growth that India has been running on. One is public investment, and the other is export growth, and that too only the services side. And if you look around, the kind of slowdown that is taking place both in Europe as well as in the US, that is likely to be hit. And I think this has already been portended by the earnings guidance by the major IT firms. So I don't really think that you're going to get much support coming out of services export. It is already, plateaued out and it's headed to slow down. So that's the reason we do have India slowing down in the second half of the fiscal year, and that continues into 2024. Into 2024, 2025. So we are looking at a growth rate which is probably around 5% in 2024, 2025, with clear downside risks because this global economy could slow down much faster, given where how tight the global financial conditions are. So this is going to be something which is not very supportive of growth. So if you're going to get a 5%, let's say, average turnaround in the next outcome in the next 2 years, it's a very good outcome.
No, 5% doesn't look good for us at all. But I'll come back to this in a minute. First, what are US yields likely to be? the 2-year to 30-year yield, that curve has moved below 5%. Is it likely to remain between 4.5% and 5%?
There are two drivers of all of this, right? So the one driver of this is that the term premium is going up, and the term premium is going up for two reasons. One is that there is a considerable amount of belief that the US will avoid a hard landing, and that the soft landing scenario with growth slowing down will still be significantly higher than what people expected about 6 months back. So that's the first driver of that. And the other, obviously, is the fiscal deficit of US, and that drove the concerns about very high issuances. The reason why it dropped down is largely because of the Fed basically saying that, look, it's going to be on hold, it's going to be data dependent. But more importantly, I think it was the guidance that came from the Treasury, which is that they are not going to be as aggressive in their bond issuance as had earlier been expected. And I think that is the reason as to why you're seeing some of the term premium going down. Now, the question is that you still have a government shutdown looming, and you still have a full year budget to contend with. The amount of issuances in next year runs significantly higher than this year, close to about $2 trillion US dollars. At the same time, you do not have the usual buyers of US bonds, namely the Fed, which is going to remain on autopilot and QT, and the foreign sovereign wealth funds. So I think it is going to be difficult. We do have a slowdown taking place in the 10-year rate, slowdown where 10-year rate goes to about 4.5% by the middle of next year, and then to about 4.25% in the second half of 2024. But again, all of that is contingent on how strong the U.S. economy remains, and more importantly, what happens to the deficit. As I said, we don't even have. The U.S. is now running on continuing resolutions one after the other, and there isn't any sense of what the full year budget is going to look like.
Oh, okay. So not that confident of fourth quarter, is it? Okay. Now, let me come to India. Why 5% for India in FY25? 1.5 percentage point lower than FY24? Why?
So just take a look at what's happening to private investment. That has been the key problem in India for not just the recent past, but at least for the last 10 years. You have both corporate and household investment, which is basically SME investment, or none of them firing. And when we talk about credit growth picking up in India, you also have to take into consideration that foreign bank borrowing as well as foreign issuance of corporates have actually gone down, and a lot of that is being substituted with domestic credit growth. So is that real credit growth? Is that credit growth additive, or simply a substitute for the foreign borrowing, whether it's by the corporates or by the banks? Yeah. So the drivers of growth, which India enjoyed, which always happened to be investment, that's just not firing. Look at FDI. FDI has fallen from that $70-80 billion run rate now to the $40 billion run rate. And by the way, all of that happens when the 10-year goes to 5.
Oh, yeah, that's right. Jahangir, it's a pleasure having you with us. Thank you so much for staying up so late for speaking to CNBC TV 18. Okay, the forecast is that US yields will go to fourth quarter, but not very happy, not very optimistic on US growth, and also seeing India growth going down to the 5 handle in FY24-25, but that's a long time away. For the moment, markets in celebratory mode. We are wrapping up on Bazaar on that optimistic note. Chartbusters